Hey everyone, welcome to this explainer. If you're a Class 12 economics student, I am so thrilled you're here. Today, we're going to build a rock-solid foundation for one of the absolute most critical chapters in your syllabus, money and banking. By the end of this session, you'll see exactly how the loose change in your pocket connects to the highest levels of our national economy. You are going to be totally prepped to crush these concepts on your exams. All right, let's get right into it.
Okay, let's dive into this with a quick scenario. Imagine you need to buy a notebook for your studies. You walk into a local stationery shop, but instead of handing over cash or scanning a QR code, you just offer the shopkeeper your smartphone. The shopkeeper kind of looks at you like you're crazy and says, I don't need a phone, I need groceries. So what's the core problem here?
To figure out why that doesn't work, here's our game plan for today. We'll cover why we need money, the functions of money, commercial banks and credit, the RBI as the central bank, controlling credit and inflation, and then a final, quick revision to lock it all in.
Kicking things off with Section 1, why exactly do we need money?
So, going back to that stationery shop, what went wrong there? Well, that old way of trading is called the barter system, where you swap goods directly. But it has a huge, fatal flaw. This is a massive keyword for your exams, guys, so lock this in. The double coincidence of wants. Essentially, for a trade to happen, both people have to want exactly what the other person has. You want the notebook, but the shopkeeper has to literally want your exact phone. No exact match, no trade. It's a complete nightmare, honestly.
Which brings us right to Section 2, the functions of money.
Because money is basically the ultimate, brilliant technological fix to that barter headache. It does four main things for us. First, it's a medium of exchange. Bam! Barter problem solved. Buying and selling is super easy. Second, it's a unit of account, giving us a common measuring stick for prices. Third, it's a store of value. You can stash it away today and it's still good to use next year. And fourth, it's a standard of deferred payment, letting us confidently sort out future payments and debts. Make sure you know these exact terms.
Now you might be wondering, what actually is money today? It's not just the crumpled cash in your wallet anymore. Modern money goes way beyond that. Today, money equals currency notes and coins, sure, plus digital payments, and, this is absolutely crucial, your bank deposits. Yep, money sitting in the bank acts as money. Understanding that is kind of the secret to unlocking how this whole economy actually works.
Let's unpack that right now in Section 3, commercial banks and credit.
So, commercial banks are where your vital deposits live. Let's say deposit 10,000 rupees into your local bank. Now, a lot of folks think the bank just takes your cash, locks it in some massive steel vault, and just sits on it until you ask for it back. But no way, they absolutely do not do that.
What they actually do is kick off this wild, progressive chain reaction known as credit creation. Here's how the engine runs. The bank accepts your initial deposit, right? Then they're required to keep a small percentage of it safe as a reserve, but the rest, they lend it right back out to borrowers. Those borrowers go spend that money out in the economy, and eventually that cash gets deposited back into another bank. That bank keeps a reserve, lends out the rest, and boom, the cycle repeats. Round and round it goes across multiple rounds, effectively creating brand new deposits out of thin air.
So how much money can actually be created from that very first deposit? Well, economists use a critical formula for this, the money multiplier. It's simply 1 divided by the reserve ratio. This bit of math dictates the theoretical limit of how much the banking system can expand that initial supply of money.
The crucial takeaway here is that there's an inverse relationship at play. If the reserve ratio is lower, the theoretical deposit multiplier is higher. Think about it. If banks only have to keep a tiny sliver of cash in reserve, they can lend out way more, expanding credit significantly. Now, just a quick caveat for your exams, this is the ideal textbook model. In the real world, actual money creation depends on a few other moving parts.
Moving right along to Section 4, RBI, the central bank.
Okay, so someone has to oversee all these commercial banks and actually decide what that reserve ratio should be, right? Enter the Reserve Bank of India, or the RBI. Examiners absolutely love asking you to contrast the RBI with a commercial bank. So let's get this straight. Commercial banks are out to make a profit. They deal directly with us, the public, accepting deposits and giving loans. The central bank? Totally different beast. The RBI does not deal directly with you or me. It regulates the entire system, implements national monetary policy, and basically acts as the banker's bank.
And beyond just regulating, it wears a few different hats to keep the economic machine running smoothly. It's the sole currency issuing authority in the country. It's the banker to the government, handling their massive transactions. Like we said, it's the banker's bank. And, most importantly for our next topic, it acts as the controller of credit.
Which leads us perfectly into Section 5, Controlling Credit and Inflation.
So this raises a huge question. How exactly does the RBI fulfill that role as the controller of credit, especially when the economy runs hot and things get way too expensive? Well, they use a highly specific quantitative toolkit. If they want to change borrowing conditions, they tweak these tools. They've got the bank rate to influence long-term lending, the repo rate, which is what they charge commercial banks for short-term funds. There's the reverse repo rate, for when banks park money back with the RBI. And of course, those reserve requirements we talked about earlier. CRR, the cash reserve ratio kept with the RBI, and SLR, the statutory liquidity ratio kept in liquid assets.
Let's make this real for a second. Imagine a scenario where spending and demand are going through the roof, and suddenly an everyday item jumps from 50 rupees up to 70 rupees. That right there is inflationary pressure, and it is bad news for everyday citizens. So what happens? The RBI steps in.
To fix those rising prices, the RBI triggers a precise cause and effect chain reaction. Step 1. They roll out a tighter monetary policy, using that toolkit we just looked at. Step 2. This directly leads to higher interest rates for commercial banks. Step 3. Because the banks are paying more, they pass that cost on to us. Borrowing becomes much more expensive for the general public. And Step 4. Since loans are so pricey now, people borrow less, they spend less, and that drop in demand naturally cools off the inflation, stabilizing prices across the economy.
All right, home stretch. Section 6, Final Quick Revision.
You guys, we have covered a ton of ground today, from trading a mobile phone for groceries all the way up to national monetary policy. Let's lock these core concepts in right before exam day. Here is your final 5-point revision. Master these, and you've got a rock-solid foundation. Number 1, money solves the barter system's exact matching problem. 2, never forget its core functions: exchange, account, value, and deferred payment. 3, commercial banks deal with the public, accepting deposits and giving out loans. 4, those banks create credit using the deposit multiplier concept. And 5, the RBI is the top dog, the central bank, influencing economic activity by adjusting monetary policy tools.
You've done an absolutely fantastic job tracking with me today. But before you close your books, I want to leave you with a bit of a brain teaser. Think about this. If the RBI's tools are constantly pulling levers to control credit, demand, and spending, how does all of that directly impact the final calculation of our total national income? Hold on to that thought, because it beautifully sets the stage for your next major chapter. Thanks for hanging out with me on this explainer. Keep studying smart, and I'll catch you in the next one.